Have you ever wondered why some people always seem to have money saved, while others live paycheck to paycheck no matter how much they earn? Is it luck? Is it a high salary? Or is there something else going on behind the scenes? Here's the truth most people never realize. Financial success rarely comes from how much money you make. It comes from how well you manage the money you already have. Think about it for a moment. There are people earning six-figure salaries who are drowning in debt, and there are people earning average incomes who have savings, investments, and financial security. So what's the difference? The answer is personal finance. And if you've never learned about personal finance before, don't worry. You're not alone. Schools rarely teach it. Many families don't talk about it, yet it's one of the most important skills you can ever learn, because understanding personal finance is the difference between constantly worrying about money and having control over your financial future. In today's video, we're going to break down personal finance basics for beginners in the simplest way possible. No complicated financial jargon. No confusing formulas, just practical knowledge that can completely change how you manage money. By the end of this video, you'll understand the core principles that financially successful people follow every day. Let's start with the first and most important concept, understanding where your money actually goes. Most people think they know how they spend their money, but when they actually track it, they're shocked. Small daily expenses quietly add up over time. A coffee here, a subscription there, online shopping, food delivery, impulse purchases. Individually, these expenses may seem small, but over months and years, they can quietly drain thousands from your bank account. This is why the first rule of personal finance is simple. You must know your numbers. That means understanding three key things: your income, your expenses, and what remains after spending. Let's start with income. Your income is simply the money you earn, whether it's from a salary, freelance work, a business, or other sources. Many people focus entirely on increasing their income. And while earning more money is great, it's only one part of the financial equation. Because if your spending increases at the same rate as your income, you'll never actually build wealth. This is something financial experts call lifestyle inflation. Lifestyle inflation happens when every time your income increases, your spending increases as well. You get a raise, so you upgrade your phone. You earn more, so you buy a nicer car. You make more money, so you start spending more on entertainment, shopping, and luxury items. Before you realize it, your higher income disappears into higher expenses, and you're back to living paycheck to paycheck again. This is why managing expenses is just as important as earning money. That brings us to the second key concept: expenses. Expenses are simply the money you spend to live your life. These usually fall into two main categories. The first category is needs. Needs are the essential expenses required for living. Things like housing, groceries, utilities, transportation, and basic health care. These are expenses that most people cannot avoid. The second category is wants. Wants include things that improve your lifestyle but aren't absolutely necessary. Things like entertainment, luxury clothing, expensive gadgets, dining out, and premium services. There's nothing wrong with spending money on things you enjoy. In fact, enjoying life is important. But the problem begins when wants start consuming most of your income. When that happens, saving money becomes almost impossible. And this leads us to the third and most powerful concept in personal finance: saving. Saving money isn't about being cheap. It's about giving your future self financial freedom. Savings protect you from unexpected emergencies. They help you avoid debt. And they create opportunities for future investments. Unfortunately, most people treat saving as an afterthought. They spend first and save whatever is left over. But financially smart people do the opposite. They save first and spend what remains. This strategy is often called pay yourself first. The idea is simple. Every time you receive income, you immediately set aside a portion for savings before spending anything else. Even if it's just 10% of your income, that habit can completely transform your financial future over time. Because saving consistently builds something incredibly powerful: financial stability. And financial stability is the foundation for the next step in personal finance: growing your money. But growing money requires a completely different mindset than simply earning and spending. And that's exactly what we'll dive into next. In the next part of this video, we're going to talk about how budgeting actually works, why most people fail at it, and the simple system beginners can use to finally take control of their finances. So if you've ever felt like money slips through your hands too quickly, the next section might completely change how you manage it. In the previous part, we talked about something most people overlook: understanding where your money actually goes, because the truth is simple. If you don't control your money will control you. And this is exactly where budgeting comes in. Now, the moment many people hear the word budget, they immediately think of restrictions. They imagine cutting out everything they enjoy. No eating out, no entertainment, no shopping. But that's not what budgeting really means. A budget is simply a plan for your money. Instead of wondering where your money went at the end of the month, a budget tells your money exactly where it should go before the month even begins. Think of it like a roadmap. If you start driving without a destination, you might end up anywhere. But if you have a clear route, every turn takes you closer to where you want to go. Your money works the same way. Without a budget, spending becomes random and emotional. But with a budget, every dollar has a purpose. Now here is the interesting part. Budgeting doesn't mean you can spend money on things you enjoy. It simply means you decide in advance how much you're comfortable spending. One of the most popular budgeting systems beginners use is called the 50-30-20 rule. And the reason it works so well is because it keeps things extremely simple. Here's how it works. 50% of your income goes toward needs. These are the essential expenses we discussed earlier. Housing, groceries, transportation, utilities, insurance, and other basic living costs. 30% of your income goes toward wants. This includes entertainment, dining out, hobbies, shopping, travel, and anything that improves your lifestyle but isn't absolutely necessary. And the remaining 20% goes toward savings and debt repayment. That includes building an emergency fund, saving for future goals, investing, or paying off loans and credit card debt. This structure creates a balance between enjoying your life today and protecting your financial future. But here's something very important beginners should understand. Your first budget will probably not be perfect, and that's completely normal. Budgeting isn't about getting everything right on the first try. It is about learning your spending habits over time. You might realize you're spending more on food than expected, or that small online purchases add up much faster than you thought. The key is simply adjusting and improving each month. Because the more aware you become of your spending habits, the easier it becomes to control them. Now, once people start budgeting, they usually run into the next big financial challenge: debt. Debt can be one of the biggest obstacles to financial freedom if it isn't managed carefully. Not all debt is necessarily bad. For example, loans for education or a home can sometimes help improve long-term financial stability, but high-interest debt, especially credit card debt, can quickly become a financial trap. Here's why. When you carry credit card balances month after month, interest charges begin stacking up. Sometimes these interest rates can exceed 20% or even 30% per year. That means the longer you carry the balance, the more expensive your purchases become. Something that originally cost $500 could eventually cost hundreds more just in interest. And this is why financially successful people treat debt very carefully. They avoid unnecessary borrowing and focus on paying off high-interest debt as quickly as possible. One popular strategy people use is called the debt snowball method. With this approach, you list all your debts from smallest to largest. Then, you focus on aggressively paying off the smallest one first while making minimum payments on the others. Once the smallest debt is gone, you move to the next one. Each paid-off balance builds momentum and motivation, just like a snowball rolling downhill and growing larger. Another strategy is the debt avalanche method. This method focuses on paying off the debt with the highest interest rate first, which saves more money over time. Both strategies work. The most important thing is simply choosing a plan and sticking to it. Because eliminating debt creates something incredibly valuable in your financial life. Freedom. Freedom from monthly payments, freedom from financial stress, freedom to start using your money for things that actually build wealth. And speaking of building wealth, there's one financial safety net that every beginner should prioritize before thinking about investments or big financial goals. It's something many people ignore until it's too late, and that is an emergency fund. Life is unpredictable. Cars break down, medical bills appear, unexpected expenses happen. Without savings, even a small emergency can force people into debt. But with an emergency fund in place, unexpected problems become manageable instead of financially devastating. And that's exactly what we're going to talk about next. In the next part, we'll break down how to build an emergency fund, why it's one of the most powerful financial tools you can have, and how beginners can start growing their money through investing. Because once your financial foundation is secure, your money can start working for you, instead of the other way around. In the previous section, we talked about budgeting and managing debt, two of the most important steps toward gaining control over your money. But now we're going to move into something that can completely change your financial life, and that is building financial protection and growing your money over time. Let's start with something that many people underestimate until they actually need it: an emergency fund. Life has a way of surprising us. Your car might suddenly break down. A medical bill might appear unexpectedly. Your phone might stop working. Or, in some cases, people even lose their jobs without warning. These situations happen to almost everyone at some point. But the difference between financial stress and financial stability often comes down to whether you have savings prepared for emergencies. An emergency fund is simply money you set aside specifically for unexpected situations. It's not meant for shopping, vacations, or daily spending. It's your financial safety net. Financial experts often recommend building an emergency fund that covers 3 to 6 months of living expenses. Now, that might sound like a large amount, especially if you're just starting your financial journey. But the key is understanding that you don't need to build it overnight. You start small. Even saving a little every month can slowly build a strong financial cushion over time. For example, if you consistently save a portion of your income every month, those small deposits gradually grow into something much more powerful. And once you have an emergency fund in place, something interesting happens. You begin to feel less financial pressure in everyday life. Unexpected problems no longer create panic. You don't have to rely on credit cards or loans to handle emergencies. Instead, you simply use the money you've already prepared. This one habit alone can prevent years of financial stress. But once your emergency fund is established, the next step in personal finance becomes even more exciting. And that step is investing. Saving money is important. But saving alone isn't enough if you want to build long-term wealth. Why? Because of something called inflation. Inflation means that over time, the cost of goods and services slowly increases. What costs $100 today might cost $120 or even $150 in the future. If your money simply sits in a bank account earning little or no interest, its purchasing power slowly decreases over time. This is where investing becomes important. Investing allows your money to grow faster than inflation, helping you build wealth in the long run. Now, for beginners, investing can sound intimidating. People often imagine complicated charts, risky decisions, or needing large amounts of money to start. But the reality is much simpler. At its core, investing means putting your money into assets that have the potential to grow over time. Some of the most common investments include stocks, bonds, mutual funds, and index funds. When you invest in stocks, for example, you are essentially buying a small ownership share in a company. As the company grows and becomes more valuable, the value of your investment may increase as well. Over long periods of time, the stock market has historically grown significantly, which is why many people use it as a tool to build wealth. But here's the most important secret about investing that beginners should understand. It's not about getting rich quickly. It's about time and consistency. Even small investments can grow into large amounts over time because of something incredibly powerful called compound growth. Compound growth means you begin earning returns not only on your original investment, but also on the profits that investment generates. In simple terms, your money starts making money, and then that new money starts making even more money. Over years and decades, this effect can dramatically increase your wealth. And that is why one of the biggest advantages you can have in personal finance is simply starting early. The earlier you begin investing, the more time your money has to grow. Even if someone starts with small amounts, consistency and patience can lead to significant financial progress. But there's one more important concept every beginner investor should understand before jumping into the market, and that concept is risk management. Investments can go up in value, but they can also go down. Markets fluctuate, prices change, and short-term losses can sometimes happen. That's why experienced investors focus on long-term strategies instead of short-term speculation. They diversify their investments, meaning they spread money across different assets instead of putting everything into one place. Diversification helps reduce risk and create more stability over time. But perhaps the most important mindset shift in personal finance is realizing that building wealth is not about one lucky investment. It's about consistent habits practiced over many years. Small savings, smart budgeting, responsible debt management, and patient investing. Together, these habits slowly build a strong financial future. And in the final part of this video, we're going to talk about something that ties all of these ideas together. We'll explore the mindset and daily habits that financially successful people follow and how beginners can start building long-term financial independence step by step. Because personal finance isn't just about numbers. It's about creating a life where money supports your goals instead of controlling your decisions. In the previous parts, we talked about the foundations of personal finance, understanding your income and expenses, creating a budget, managing debt, building an emergency fund, and starting to invest. These are the practical steps that help you control your money. But there is one more piece of the puzzle that many people overlook, and that is your financial mindset. Because the truth is, personal finance is not just about numbers. It's about behavior. Two people can earn the exact same salary, yet end up with completely different financial futures. One may struggle with debt and constant financial stress. The other may gradually build savings, investments, and long-term security. The difference often comes down to habits and mindset. Financially successful people tend to follow a few simple principles that guide their decisions over time. The first principle is long-term thinking. Most people focus only on immediate gratification. They want results today. They want the newest phone today, the newest car today, the best lifestyle right now. But financially disciplined people think differently. Before making large purchases, they often ask themselves a simple question. Will this decision improve my financial future or hurt it? This doesn't mean they never spend money on things they enjoy. It simply means they balance present enjoyment with future security. And that balance is what keeps their finances healthy over time. Another powerful habit is living below your means. This concept is surprisingly simple, yet extremely powerful. Living below your means simply means spending less than you earn. It sounds obvious, but many people do the opposite. As soon as their income increases, their spending increases even faster. They upgrade their lifestyle immediately. Bigger house, newer car, more expensive habits. And while there's nothing wrong with improving your lifestyle, problems arise when spending grows faster than income. Financially successful individuals avoid this trap. Instead of increasing spending every time they earn more money, they often increase their savings and investments first. Over time, this creates a powerful wealth-building effect, because the more money you invest, the more opportunities you create for future growth. Another important mindset shift involves delayed gratification. Delayed gratification means being willing to wait today in order to gain something better in the future. For example, someone might delay buying luxury items so they can invest that money instead. Years later, those investments may grow enough to create financial freedom. This ability to delay short-term pleasure for long-term gain is one of the strongest predictors of financial success. But even with the right mindset, beginners often make a few common mistakes when managing their money. And avoiding these mistakes can save you a lot of financial trouble. One common mistake is not tracking spending without tracking expenses. It's very easy for money to disappear without realizing where it went. Another mistake is relying too heavily on credit cards. Credit cards can be useful tools if used responsibly. But when people spend more than they can repay, high interest charges can quickly turn small purchases into large financial burdens. A third common mistake is waiting too long to start saving or investing. Many people delay financial planning because they believe they don't earn enough money yet. But the reality is that financial habits matter far more than the starting amount. Even small savings can grow significantly over time if they are invested consistently. This is why starting early is one of the biggest advantages anyone can have in personal finance. Now, as we bring everything together, let's review the key principles we discussed in this video. First, understand your money. Know how much you earn and where your money goes each month. Second, create a simple budget that balances needs, wants, and savings. Third, avoid unnecessary debt and work toward paying off high-interest obligations as quickly as possible. Fourth, build an emergency fund to protect yourself from unexpected financial shocks. Fifth, begin investing early so your money can grow over time. And finally, develop a financial mindset focused on patience, discipline, and long-term thinking. When these principles work together, something powerful happens. Money stops being a constant source of stress. Instead, it becomes a tool that helps you build the life you want. Financial freedom doesn't happen overnight. It's built slowly through small, consistent decisions made every day. The good news is that anyone can start this journey, regardless of their current income or financial situation, because personal finance is not about being perfect. It's about making better choices over time. And every smart financial decision you make today is a step toward a more secure and independent future. So if you're just starting to learn about money management, remember this. The sooner you take control of your finances, the sooner your finances will start working for you. And that was the real goal of personal finance, creating a life where money supports your goals instead of limiting them.